In the last two sessions, we were hearing directly from the entrepreneurs. So these are the people that we're backing to head in and buy these businesses and the journeys that they go on. Now, this afternoon, we're going to hear from the capital providers. We're going to hear from the lenders and we're going to hear from the investors. And these two groups are really, really critical. I mean, these are the guys that are providing the firepower to these entrepreneurs to head out and buy these businesses. And the way in which they engage with those entrepreneurs is critical to the success of this process. Up on stage, we're very lucky to have a number of very experienced lenders. It's kind of one of those situations where with them all on the stage here, we feel like we should pepper them with all sorts of deals to see what kind of terms we can get out of them all at the same time, right? Is this going to be some kind of auction bidding process, maybe? Who's got a deal that they need funded right now? Yeah, right. Okay, we've got a few. Yeah, excellent. Right. And ably moderated by Tom McGhie from McGhie, who's one of our excellent sponsors here over the last couple of years. And so thank you very much, Tom, for coming back to do this and also for moderating this group. So I'll hand it over to Tom to introduce the guys and we'll have a discussion around how lenders approach this process and how they can support entrepreneurs in the journey. Thanks.
Thanks, Pete. So as Pete was talking to, and obviously on the screen, we're going to have a bit of a chat about how lenders deal with business turbulence, and in the context and certainly the theme of the conference being resilience, that takes a few forms. And so to structure this up a little bit, we're going to look at sort of three parts to this. First of all, we can do some definitions or some real life examples of what is business turbulence. So what are we actually talking about? And then we'll talk to some of the things we really should think about in terms of the tools of lending. So alignment, what is that actually all about? And structuring, what's that all about? And then we'll finish off with selecting the right lender. On the panel, we've got four people, which are all very experienced. Really appreciate all of them making the time to be here. First of all, to my left, Michael Kurland is the Joint Managing Director and founder of Arrowpoint Capital, who's an Australian-based direct lender and provides debt solutions to deals larger than about $5 million. You can always ask Michael whether yours if it's a little lower, but certainly around that level. And looks across both Australia and New Zealand in terms of their product range. Michael's had well over 20 years of experience in structuring debt, both in banking and non-banking sectors here in Australia, South Africa, you can tell by his accent, and also the UK. Then we have Alex Miller. Alex is a director at Longreach Credit Investors, which is also a private credit investment management firm, but also a direct lending fund. The firm's objective is to lend to diversified assets, and again, roughly in the size of between sort of 3 million and up to about sort of 50 million in size, both here in Australia and New Zealand. And then we have John Ferrara. John's the co-founder of Private Capital Group in New Zealand, which is also a direct lender. But John's also had experience here in Australia in the context of banking at some of the major banks here in Australia, so provides both experiences from his perspective. The point to make here is that both Michael, John, and Alex all represent lenders that have lent to the EtA community in a non-bank context. So, and still are lending to those groups. And finally, we have Geoff on my left, your right. So Geoff is a chartered accountant by background and has significant experience in acting for and continues to act for in an advisory context. CEOs, CFOs, boards, basically when complex negotiations get a bit difficult or a bit complex. His business is Harbourside Advisory. Geoff also consults as an expert witness in sort of situations that require court action, but also draws from his experience being you know, a direct decisioner in the context of restructuring loans at large banks, specifically NAB and ANZ.
So don't pitch deals to me because I'm not a funder. I'm an imposter.
Yes.
And when I was a banker, I was the sort of banker that no one wanted to talk to because I was in bad bank, right?
That's
all the euphemisms, but I was in bad bank.
100%. And that's certainly a name that kind of gets thrown around, and we can maybe touch on that a bit later. As an extended introduction to everybody here, there is a podcast on the EtA Central platform, which you can pick up sort of some more detailed views on some of this stuff, on the backgrounds of who we are. But we've done that so that we can truncate the process of introduction and context, and let's sort of jump more into it. Geoff, I'm going to jump to you first in the context of business turbulence. What is it in a practical sense? And is there some common causes?
So I think the old Monty Python, no one expects the Spanish Inquisition, comes to mind. No, if you could have planned for it, you would have. It's something unexpected that you didn't look for, and it's a surprise. The thing I would say, increasingly, it seems to be fraud. There'll be employee fraud. In this space, you also see I'd call it vendor fraud, that the purchaser of a business didn't get all of the assets that they signed up for, or some contracts had some different terms and they had to pay more, and things like that. So fraud just seems to be a growing source. But yeah, it's usually the unexpected things. And the thing that I've talked to Tom about is when things are going well for a business, everybody loves you for your EBITDA, right? And maybe they even love you, if you're really lucky, they love you for your normalized EBITDA. When things get tough, people like us say, oh, let's talk about your cash flow. And there's a lot of people who haven't thought about their cash flow because everybody loves you for your EBITDA. So you manage your EBITDA, you report your EBITDA, you track your EBITDA, and you haven't thought too much about cash flow. And I call it a real whiplash effect, because you go from being people that everyone was chasing after because we really wanted your business, and now we're sort of staring at you because you've let us down a little bit on what's going on. And we also want to talk to you about your cash flow, and maybe you haven't had to think about it. So taking a little bit of a detour from the script, I would say, so one of the things, so chartered accountant by trade and a few Ks on the clock, just because nobody asks you, don't not manage your cash flow. And I would say, by the way, the monthly reconciliation that your finance person should do between your change in your cash position and the profit that you made, your EBITDA, getting really boring and technical here, that's just about my number one piece of advice to anybody ever in business. If you don't get those two things reconciled, you don't know the difference between your cash position, your EBITDA, you don't know where it is, and you actually don't know that your accounting system is working. That's the detour. But yeah, the big whiplash, you were here and now you're here, and usually that happens all at a sudden. And a lot of businesses and borrowers, when that happens, they're a bit bewildered
because the cash ran out. Yep. John, I might jump to you in the context of just sort of extrapolating a little bit on that. Some of the early warning signs, I've just mentioned one of them, but certainly there's a few others, of when do we see business turbulence starting to appear?
Yeah, I think you can group them into a few different categories. I'd say the first one is financial performance. So at the outset, when we're undertaking our credit assessment, we establish what the KPIs of the business are. And so then we can track the KPIs through the financial reporting that's provided by the borrower. So that really allows us to, gives us the best chance to identify those key warning signs through the numbers, and also ensure that cash is being managed effectively within the business. Liquidity stress can accelerate, other underlying issues within the business. And a breach of financial covenants can be an outcome of business turbulence, but tends not to be an early warning sign. Through tracking the trends in the financial performance, we can, however, potentially anticipate a breach and find a solution ahead of time. The second point, or the second area, is more behavioural. Management meetings are critical because it helps us to ensure that there's consistency in the message relative to what is actually being delivered. And where the two start to drift, then we need to find out why. Site visits, where relevant, can be important. So take a factory, for instance. Being able to assess the activity on the factory floor can be a good indicator. Management departures that are sort of unexplained can be a sign that something's not quite right. So that's the more micro. At the more macro level, changes in the industry. So competitor activity. If there's a new competitor that enters the market, that potentially could affect market share. And then at the sort of the macroeconomic level, there's a few points there. Sort of economic activity. We'd expect subdued activity to affect demand. Changes in interest rates, actual or expected changes, obviously will affect the interest burden of the borrower, and also has the more lagging effect in the wider economy that that could also affect demand. And then changes in government regulation. So, for instance, in the bank, we had a borrower that was exposed to a change in the minimum wage, but because they understood their labour profile, they were able to plan ahead for that. There's others that fall within those categories, and they each have varying degrees of probability of occurring and also impact. When we're undertaking our credit assessment and we've decided to lend money, the hope is always that the loan will perform with low volatility. But the reality is that a lot of borrowers will require a waiver of a breach or an amendment, or they might require an extension or a combination of the three. I think that's just the reality of lending to this market.
Yeah. Okay. And we'll circle back to some of that in the sort of the second segment as well, around sort of structure and sort of what that might mean. But I guess before we get into that, Alex, maybe just sort of picking up on some of those themes about turbulence, as Geoff was saying, sort of when those things happen, how do you expect the management to turn up sort of during that process? And what are you expecting from the sort of the CEO specifically? Some of the searches might be that role for the first time.
Yep. I think a lot of this comes back to certainly at Longreach, we operate on a pretty relationship-driven basis. So when we first meet the company before we've written the loan, we really spend a lot of time in close consultation working with the management team, the shareholders, the debt advisors, the equity advisors, whoever it may be. And we really, I suppose it's during that first phase where we start to get an understanding of the business and we start to create that trusted relationship that exists between Longreach and a prospective borrower. So I think that's important to set the scene up front. That's the approach that Longreach takes. And what we're very careful of is maintaining that approach once we've written the loan. So Longreach will ordinarily only see, 2 or 3 people from our team during the duration of the deal. And the idea behind that is if and when wobbles are to occur at a company, a CEO or CFO won't be afraid of approaching us. We definitely prefer, and try and demand timely and transparent provision of information. As John said, ultimately a forecast is a forecast, and things will go to plan inevitably. The easiest way for a credit fund to be able to navigate through those ups and downs is to get the earliest possible warning of when they're going to occur. That allows us enough time to work with the company, work with shareholders, work with our internal team, get our investment committee up the curve, all aimed at trying to deliver a timely outcome for the borrower, because obviously we appreciate that a lot of these situations can be time critical. Capital can be needed within a matter of weeks. Waivers can be needed very quickly. So that's probably my answer.
Yeah, and so I'm going to sort of segue back to you there, Geoff, in the context that the timeliness of reporting, and certainly kind of where Alex is saying, picking up on those signs early as possible, or as early as possible. When should I approach a lender from your experience of receiving thousands of these calls over the years?
Yeah, I reckon I've been to probably 20 panels where this question gets asked, and all the lenders up sitting on the stage, as soon as possible, right? Or sooner than as possible. That's when you should tell us about a problem, or even sooner than that if you possibly can, right? Oh, frog shit. That is dreadful. I'm on the other side of the table now, so I'll tell you the truth. Frog shit. I've sat there when someone's come and said, "Oh, borrower X has got a problem," and you say, "Oh, how bad is it?" No, they don't know. What are they doing about it? Oh, they don't know. Oh, okay. Why did they call us? You tell the bank when you know, or your lender, sorry, fellas, when you know what your response is. It might not be a complete response, but this is how bad we think it will be, right? Hitting our budget is not under threat, or we might be at the bottom end of the range, or we are going to be towards our covenant, or we might be breaching our covenant. But you've got to be able to give an indication of how bad it will be, and you've got to say what you're doing to fix it, right? And that is your response. And I gave you the worst I'd ever heard in terms of advice. One of my customers, after I left the bank, we've got to go and talk to our lender and explain that COVID has knocked the business around. And we walked in, and my fellow said, "Now I'm briefing you to tell you that I've just made half the workforce redundant because I'm not sure of the impact of COVID." And the bank's just sitting there going, "Okay, we think you're committed. Change. We understand where you're at. You're pretty determined." And it was just conversation over, because he had a good response. So I'm not saying don't tell them, or stall if I'm saying try to have at least a partial response. And maybe all it is going to be, we're still working on our plan. This is what we've started. But anytime you've got a problem, whether it's business is underperforming, covenant under pressure, covenant threat, or something horrible, we've just discovered a fraud, we've lost a major contract, your lender always wants to know what your response is. So you need to know what your response is to be able to articulate it to them.
So I'm gonna sort of summarize those three sort of question or response points and put this to you, Michael. That sort of, if you said, I need to walk into the room as a manager in control of my business with an appropriate management response when you come and talk to your lender, that's really what we expect of you as lenders?
Yes, I guess. Hi, everyone. And just a quick note: I share Alex's position because we're similar, just 5 basis points less. That's all. Wow. But
Better jokes, Michael. Better jokes.
liven up the mood a bit. Yeah, the truth is, it all comes down to the people that you backed at the beginning. I can't stress that enough. You choosing us as lenders, we choosing you as borrowers. You're in this whole ecosystem that's ETA, your relationship with the vendor that you're buying, the business that you're in, all the stakeholders. It's just it really comes down to that, and who you pick as your jockeys, the transition risk that comes with it, how the vendor's exiting, all that sort of stuff. Because if you pick good people, good lenders in the whole ecosystem that's your ETA purchase, let's say, then you can get through most things, right? And you can work it out. So to your point is 100% right. But if you've built that relationship, what Alex has mentioned, then you always having these conversations. And as the sort of alternative lenders that we are, we're not a bank. We don't come with obviously the bank pricing, but what us, Longreach, and our peers come with is that flexibility, that speed, that relationship, that ability to help work out, because none of us actually want to go through the issues of you breach a covenant and send it to a bad bank. We at Arrowpoint, we had one bad deal. Not bad because we got all our money back because we're senior lenders, but the biggest sort of reason for that was backing the wrong management team where they didn't have much skin in the game, and they could just look at you and go, well, we're just professional managers, so who cares really? Whereas the nice thing about this world, and it's growing, is you have skin in the game. And if we waking up at 6 o'clock in the morning because we have an issue with you as a borrower, then we know you're waking up at 5 o'clock with a lot more to lose and gain. And that's the beauty of this space. It's not easy to find deals, and the whole thing of gambit of doing the deals. If you pick the right lender, 5 basis points less, then you can work through those situations.
So if we sort of extrapolate on that, then into starting to think about sort of structuring and alignment and sort of the setup of deals, you're touching on those points sort of there in already, but sort of alignment of risks between the borrower and the lender. What do you think, and what does that mean?
Right at the beginning is the who before the what, as we've spoken about, and that's vital in everything in life, but certainly in finance. And then once you've got through that and the right sector and it makes sense and it's not flighty, and we might be slightly different scope of mandate to others on the panel, but let's say we can get around sector, and then it comes down to 2 important aspects: leverage and gearing is next. And leverage is obviously the multiple that you pay, but more the multiple that you're borrowing at. And to your point, EBITDA is great, but EBITDA to free cash flow conversion is even more important to service the debt. High growth business is obviously great from an equity perspective, but not necessarily great from a debt perspective, etc. So that's the challenge. So then I can't tell you how many, and I'm sure the guys on the panel will say the same, how many people come to us saying we've got a great business, looks great, sounds great, but they don't have much equity. And they believe they've negotiated a great term sheet with the vendor because there's vendor finance and whatever else you can structure, but you need that alignment with equity. So we're not really that interested, to be honest, and I'm sure the guys feel the same if there isn't that alignment where they want all the equity upside but no risk. And how many people come and go, we don't have the equity, but we're buying at such cheap multiples so you can almost fund the whole thing. Arguably that could be true, but not in our case, because that alignment of leverage is important, but gearing and relative alignment is more important. Now you can do certain tweaks around profit shares and equity shares, with giving a little bit more gearing and being a lot more flexible than the banks, etc. But gearing in relation to leverage, right people, knowing that even turkeys can fly in hurricanes. So, you need to know what happens if things go badly in that sector, etc. And those are the sort of, then from that bucket, all the other things start to fill out, right? Long form docs and budgets and covenants and all these good things that start going. And I think the trick for, and I'm talking too much, so the trick for this forum is trying to get your lender in as soon as possible, because you need debt, you need equity. And then the most important thing is what you're actually doing is negotiating the buy side, which we are on with you anyway. So you need that lender to come with you for that journey, so that it's not an impediment at the end, but you actually have that sort of seamless transition to an acquisition on the back end. So I hope that answers some of it. But
Yeah. John, I'm going to get you to pick up on some of that too, in the sense of just then sort of some of the tools and structuring tools you might think about, which Michael's started to touch on, but so like I think there's probably more there to build on to create alignment. Like, how are we creating alignment between the borrower?
Yeah. So as Michael just mentioned, the debt to equity ratio is obviously the key one. And then, the transaction leverage, total debt over divide by EBITDA. I think because of the denominator effect in that equation, $1 of EBITDA, let's go back a step. You can reduce your transaction leverage in two ways. You can either pay back debt or you can increase your EBITDA. So given that denominator effect, $1 of EBITDA is going to have more benefit or more result in more reduction in leverage than $1 reduction in debt. So I think that's a good alignment and good incentive for borrowers. I'd say the term as well, the term of the debt. So for an acquisition finance type deal, typically the term correlates to the investment horizon. Obviously, shorter dated debt is less risky than longer dated debt, given more uncertainty. So I think that's a good alignment there. And then there's the pricing. So it's a function of an upfront fee and an interest margin. And typically in some transactions, you'll have a margin grid. So the cost of finance will move up and down depending on changes in that leverage and therefore the risk. So I think that's a good area of alignment. But above all else, I think it's important to understand the context for why a debt structure is so important for us as lenders. Because as lenders, we're exposed to the asymmetric risk to the downside, which means that we obviously don't participate in any value creation. We're exposed to the downside, and in return, we get a set contractual return. So the structure's there to preserve firm value and therefore our capital. And it's also there to protect our return. And so where the risk changes, then, where the mechanism in the structure to adjust that pricing to reflect the new risk.
And so that's ultimately sort of often referred to as default risk, right? And particularly if there's a covenant breach or something like that, there can be essentially a mechanism to add price to compensate for an adjusted risk profile. Is that something that you guys work to? You've seen, is it effective, and at what point does it become not effective, I guess, is probably the other question.
I think within reason. So when we go into a transaction, it's on the basis of certain risk parameters, and the pricing is, our return is a function of that risk. Where the risk changes, we have our own investors that we have to answer to, who are asking us what's going on. So as investors, we need to earn a return, a suitable risk adjusted return. So when the risk changes, then it's not necessarily in a default situation either. It might be for an amendment, or there needs to be that sort of that consideration as well.
Yeah. Geoff, what about from your perspective in terms of pricing for risk? How do you think about that? And certainly, I guess maybe a little different from a bank perspective to a non-bank, but
an unscripted question, Tom. I always felt it could help you some of the way, but then towards the end of the spectrum, it just, you can't possibly price for the risk that's there. So it can sort in the middle bit, it can give people a signal and make them think about things, but it's probably more of a communication tool or something rather than a problem solver by itself, I would say, because you get to the point where you can't price for the risk that's too high.
Yeah. Michael, you've had a situation where in the past you've got the alignment wrong, and you sort of touched on it there before, but is there any extrapolation on sort of, I suppose, alignment of people and examples you've seen where that hasn't necessarily worked out well?
Yeah, I mean, our one was a smallish listed business where the guy could turn around and they made an acquisition which faltered quite quickly when the rates went up. And we worked through it as a senior lender. I mean, they were very cooperative, but they didn't want to ever really admit to the incorrect acquisition, which meant they were starting to throw the baby out with the bathwater. And at some point, as a senior lender, you have to take action, which you never really want to do. But unfortunately, at some point, you may have to. There was that communication, but there was just a never recognition of how they're going to get it right, even with their investors. And because it was listed, which is different to where we're speaking now, it was getting a bit difficult for us because we knew more information in the market. And what they were putting out to the market wasn't quite how we wanted to communicate to our investors. So with that discomfort, expedited things, which was challenging. And a couple of lessons there was, again, it came down to backing the people, where you learned that give you an example, and this will be what the businesses everyone here is looking at. We only really later reflected in our due diligence that, for example, the CEO never really walked around the factory floor, as an example, to the point earlier. So there's nothing better than in your businesses, just go and spend half a day at site, just watch what's going on. Like there's no better learning than that. And you'll very quickly get the pulse of the business and the happiness of the workers. I mean, some businesses are different because it's just a desk or whatever, but depending on what sector you're in, but it's those sorts of things. And because it was a listed business and you're dealing with the CEO in that example, and that's why, again, this is why this forum is so good, because you're really putting your heart and soul into your next acquisition. It could be your first acquisition. In many cases, you maybe mortgage your house for that. This is your opportunity to hit it big. That's what we like, and I'm sure the guys on the stage, because this could be your nest egg if you get it right. So you're spending hundreds of hours and many phone calls to find the right acquisition, and there's no better effort from us as lenders to be part of that journey, rather than a CEO turning around to me and saying, "I'm just a professional manager," and basically stuff off, it's your problem now. And that's why this sort of private world, where there's so much change of the baby boomer generation and so many needles, which means all of us have an opportunity on our side to build businesses with you guys, with the borrowers, because you only have to find. We did 8 deals last year. I think Longreach did about 12. You don't have to do hundreds. You just have to backlit people in good businesses, and that's ultimately what it comes down to.
Yeah, absolutely. So we'll segue into selecting the right lender, and I think that's certainly a conversation point to what you were saying before about picking the right jockey. In a lot of my discussions, I suppose, with people in the room, I guess probably reflecting for today, quite a common question I get is sort of how much debt can I get on this particular deal, and I guess sort of as a starting point, it's rarely about price. It's rarely about leverage, and in fact, it's sort of a lot deeper than that. Is where we need to start in terms of strategy and how things are going to evolve going forward. Alex, so what other ways can lenders assist with finding solutions to turbulence up front and thinking about who to work with and which lender to work with?
Yeah, and I wouldn't say it's just about price. I mean, ultimately, the searchers in this room and the companies, it's going to come down to how much debt you want to use in your transaction, and that's pretty simply going to put you either into mainstream banking or it's going to put you into the world of private credit. And And then the private credit operators like Arrowpoint and like Longreach, and I think like PCG, all have a fairly similar pricing structure. We'll all obviously yeah. Less 5. We can just provide slightly more. So it's more, yes, it's price, yes, it's structure, yes, it's management team, yes, we'll look at leverage at Longreach, just from a leverage perspective. Ordinarily, we look at putting on a cash flow loan somewhere between 2 and 4 times leverage on a business. Obviously, the amount of leverage we put into a business is going to come down to all the typical risk factors that you will be looking at as well in terms of how you view the investment risks. Obviously, we'll be looking at who the searcher is acquiring, at what is his or her experience, how long's the business been around, what's their track record of cash flow generation, what's their track record of debt serviceability. All those types of questions we'll look at, which will help us ultimately, hopefully, put together a financing proposal for the opportunity. Now I've lost track of what the actual question was.
You're on track. That's all right.
But other ways lenders can help. So as I said up the front, it's definitely a relationship-based approach. As I said, you're not going to just see us up front during execution phase and then we're going to go away and hide in the back room and you'll never see us again. We'll be there for the journey alongside you through the ups and downs. We are routinely introducing portfolio companies to private equity funds, investment funds. We're routinely helping companies with new C-suite hires, with new management hires. Wherever we can help upskill a business, ultimately will help de-risk our credit. So we are absolutely there to do that in any way possible. And we've been in this game now at Longreach for 6 years. Got a fairly deep network of trusted advisors that we can turn to. So we like to think that we can sort of bring those skills to bear with our borrowers.
Can I pick up on Michael's 5 basis points point? People get so carried away with the interest rate as a percentage, right? What's my rate? I had a borrower say, "Oh, Geoff, I think I can get them down another 5 points." And I said, "Please pull out your calculator and tell me what 5 points is in dollars." Right? "Oh, it's $35,000. Right? And I said, "If I were you, I would sign that term sheet before your lender realizes they haven't given you any covenants." But people don't, it's not that much money, right? 30
Arrowpoint.
Which lenders are those? Is that how he's winning all the work?
A bank I used to work for, but I wasn't working for them when we did that deal. But like people get lost in how much money is it? What are you going to do with the money that you buy? If it lets you execute the strategy, what is executing the strategy worth to you versus $35,000, whatever? So but is it an Australian thing? I don't know, but it's Australian business people seem to get carried away with the headline rate rather than what's the total cost. What's the benefit of doing whatever it is this is funding, and what do I get out of it?
Can I pick up on one thing quickly? For everyone in the room, this is where it becomes really...
Still 5 points cheaper though.
No, we've actually gone up because of covenants, but we're back to parity. For everyone in the room, to make it quite relevant, and this is picking up on what Alex said, where can we add value which maybe banks don't? And again, comes down to relationship, but we've seen a lot of deals in our time. For everyone that's sitting here, you've done one deal or are looking at a few deals, particularly while it's in such an interesting space, you don't know what you don't know. So you do need a good advisor like Tom, particularly if he selects the right lender. That's on the right-hand side lender. But there are so many little traps but opportunities when you're negotiating, for example. So the most important agreement to come back is that par with the seller and the relationship with the seller, and does the legacy, I think, as Ryan said earlier, want to be preserved in his transaction. So all those little things, but it's even more than that. It's the deferred piece that you may or might have. It's the earnout that you may or might not structure. It's all these little things in your SPA, which is going to be the main agreement, and then your shareholder agreement, and how that interplays with your loan as well. So when you're going to a bank, you're just one of thousands. With us, you're one of few, and you probably want your lender to take a look at the SPA relationship and how do you carve future payments out if it's deferred piece. You probably haven't thought of that yet as an example, but that's crucially important because you don't want to get 6 months down the line and you owe the lender more money and you forgot how are we funding it? Or I didn't have enough equity, or you don't get your equity on settlement, etc. So the sooner you actually, because remember that as a lender, we're on the same side of the balance sheet and we're on the buy side with you. So there's so much, the questions that you're asking around EBITDA and growth and possibilities are identical. Is it diversified? What's the revenue? Who are you buying from? The only difference starts to deviate really is security structure. And in a way, we actually don't want that much growth because growth is more difficult because you want to move money from growth to pay debt and all that sort of stuff. But you're all on the same side here. So work together, find the faults. The worst case is we come and say, did you think of this? And you go, geez, that's a risk I can't do. And then your hard-earned money that you're about to plow into it. So you spent 50,000 on credit, on debt, on advisors or something, but you found something where you're not putting your life savings into an opportunity because there was a defect in the business that we've helped identify. But at the flip side, this is a major life move for all of you in this room. And you don't want to get it wrong. So get your right advisors, get the right people around the table, and don't care about the 5 basis points that's no longer there. Is the response.
I think you said earlier as well. I think try and come as early as you can to the private credit funds as well in your process. I know that a lot of you are going to be looking at using banks for your debt. But ultimately, whether you use bank debt, I think often in search is dependent on how much equity you raise. And I think in search in Australia, that's obviously a little bit lumpy as to how much you raise because you're so dependent on a disparate group of search funds in US and Europe and Australia, right? So although you might think you're raising 10 million up front, you might come 5 months later and you only got 5 million, in which case you're back in the world of private credit. And private credit funds, whilst we can move very quickly and we're nimble and all the usual things that private credit says, which is true, if we get brought in too late, it becomes very difficult. And private credit, naturally, we run our own investment funds. So we don't have unlimited balance sheets. So clearly, we're not wanting to take the same kind of loss risk that a bank does. So the level of diligence the private credit fund will often be, much deeper than a bank. So we need to be afforded that time to run a process to put that debt in place. So don't leave us until 2 weeks out from theoretical financial close and think you're going to get a facility from a private credit fund. I think that's unrealistic.
Tom, if I can just maybe give a practical example where I think private credit's got the edge on banks. Quite often, the discussion comes down to, hey, everybody, time for equity to come to the party, right? And in fact, if anybody gets into a problem with their lender and their lender doesn't say, this sounds like it's equity's problem, not ours, right? Phone me and I'll take you to lunch at the establishment if that actually happens to you, because I think I'm pretty safe. But they'll say, time for equity to come to the party, and I had a borrower in that position. So equity's ready to go. The loan is in breach. So we say we would like some tenor. So tenor is the length of time until expiry. So give us a longer term. And we want some covenant headroom. So headroom's the gap between your actual performance and your covenants, right? We need a reset because the investors can't put their money into a deal that is going to default in 3 months' time. Bank that's fairly early on in the alphabet could not get their head around that, right? So they say, we want equity. We say, we're ready to go. We need tenor and headroom. and the $1 million that you've asked for will come into the business, and they could not give us a credit decision, and they couldn't get their heads around the fact that there's an investment committee that actually has to sign off on new money going in, and it has its own criteria, and it has to work through its own decision process. And the people up here have got their own investment committees, so they understand the questions that investment committees will have. And I would say to you, if you are going to be having a discussion that sort of goes round in that circle where you're saying, lender, help us to help you, we can get equity in, but you've got to give us something. To me, that is a much easier discussion with the people on this dais than probably with a trading bank.
Absolutely. And I suppose extending those thoughts into just other things to think about when setting up a transaction and selecting the lender that you're going to work with. I think we've heard a lot today about plan for the unknown, the things that you don't know are the things that are going to cause turbulence, perhaps, as a sort of a précis of the comments earlier. John, Alex, Michael, anybody want to sort of jump in and just give us other things about what you guys do that give more flexibility and the reasons why we would think about that path as opposed to a trading bank?
I'll give one example if I may. Equity core risk is a big issue in the ETA world. So many of you would have Wayfinder and others, private capital lined up that you think you've got lined up for a transaction. So you have found your equity, you've had a good story, they back you, all those good things. But when the transaction happens, you still have to make damn sure that they're there on that day. And the more investors you've got, the less likely, the more likely one may pull out, even if it's for 100,000. You're now short 100,000. That's that. Yeah, you need to come up with the agreed money on the day, otherwise you default and your name's toast and whatever it is in your SPA. So just also have a conversation with your lender as to that possibility. And even though, let's say we're doing a $5 million deal, and but there's a little bit of a risk that equity is not going to be there for, it's say, 4 million. See if that there's in a conversation early on that maybe the last minute we could go to 5.5 if that could happen, even though we've agreed that. But if I phoned you and said I need 5.5, and maybe we just have to charge it, to your point, a few basis points more for a little period of time, just see if that us or Longreach, whoever you choose to use, is able to give you a little bit more flex, even though you may not use us, because you just don't want the situation where suddenly an equity guy says, actually, I've just invested in property or US stocks because you're taking too long or whatever it is. And suddenly your money isn't there as much as you thought. And that's a real risk. So have that conversation as well, because it could just be a phone call, which is, yeah, sure, we can activate that in 5 minutes. And we can do that, whereas good luck getting that from the bank with the A or the W or anywhere in between. So that's just another one. This is equity core risk, which is something to just look out for.
We're getting the wind up, so I think we've got to hold in there unless anybody has some final burning comments. No, we might jump to questions.
We can take a couple of questions, and they can't be deal specific. If you've got those, you've got to chase these guys after. But has anyone got any questions? We've got a lot of experience sitting on the stage up here at the moment. Yeah, we've got any questions? Or is it a bit like having oh, there we go. We got one.
About skin in the game and alignment with back. How do you think about actual cash skin in the game versus participation and promoter structure? Where someone's got a lot of upside at risk, but they haven't necessarily put hard cash in. What do you differentiate between those when you think about, is this person aligned?
Yeah, I mean, I think that's a common structure in search, right? Where you've got a CEO coming in and there's not necessarily a significant chunk of cash equity coming in. It's all driven to them achieving their targets and milestones and triggering equity at that point. But I think as a credit fund, where we take comfort in search is the amount of equity capital you're raising to fund these transactions, which, to be honest, is kind of outweighs other sectors in terms of the equity debt mix that I tend to see in search. So I don't see that as an issue per se.
Any other questions? It is a little bit like a panel of GPs. You don't really want to ask your question. It's a little bit personal, right? I get that. I've got a few questions, but I'll keep those for later as well. Thank you very much, guys. We really appreciate having you up here and all of the experience that you've got. And, thanks also, because I know that all three of you guys are actively supporting deals in this community, and we really, really appreciate it and looking forward to more in the future. And thanks to Tom for moderating.